Hello, and welcome to the Pearl Planning 2022 kickoff webinar on economic update and investment outlook. I'm Melissa Joy, and so pleased to be joined by, and if you guys can wave so everybody knows who you are, Hannah Neer, Melissa Fradenburg, and Alexa Kane. Today, we're going to be talking about the markets as they kind of left us as we start the year. And then, of course, it's been a busy few weeks, definitely with a little more volatility than it has been in the past. We're going to talk to you about what's going on in the economy and really anchor all of that conversation back to the financial planning wisdom that we know helps people manage through all types of investment environments, including the environment that we have here in 2022. So without further ado, I'm going to kick things off and share the screen. Here we are again on a good hair day. That's the team at Pearl Planning. And then we move on to our agenda. Just a reminder as we get started that we do have a Q&A function. So you can leave questions and we'll make sure to get to them in conversation. And we will also provide our contact details at the end of the presentation so that if you have any specific questions you'd like to reach out for the team, we would welcome those. And this webinar is being recorded, so we will put it up on our YouTube channel, share on social media, and send a follow-up email in case you have any questions. So just an FYI on that. And then we're going to dive right into it. We're going to talk about the markets and volatility from the beginning of the year, the economy. Inflation is a hot topic that I know many of our clients are very interested in knowing about and how we respond to it, interest rates, and then stock and bond markets. And then we will open things up for Q&A. So with that, I will just give you a reminder, because we're going to talk about volatility first, that we work with clients and we invest on behalf of clients, knowing that the stock market is not only a fair weather endeavor, and we make sure that you are being prepared in terms of your financial life in general, like your overall life, as well as how your investment portfolios are built. And so this is a kind of a checklist of when you should be concerned, when you need to, kind of wipe out your strategy, and when it makes sense to kind of stay constructive and stay the course. And so, even if, when we're not anywhere near a bear market territory, even if we were in a bear market, we have planned for those types of eventualities throughout your financial plan. And so we're still in the green checkbox area when it comes to the work we're doing with our clients and the work we're doing on investments. So just a reminder that all of the things that are happening are within the investment process. So 2021 was a highly unusual year, and we're going to show you that in a couple different charts. But you can see in light blue here that since March of 2020, there has not been a pullback of greater than 10% leading into the end of December. And in fact, if you look at the close of business numbers, even through yesterday, actually the day before, I should say. But so we have a very long duration, or a long period of time, many days. This is close to a record going back over the last 50 years or so of how many days it's been since you had a 10% pullback. So that is important to remember, because that kind of normalizes kind of comfort zone of lower risk. And you need to kind of get used to volatility again when losses or down markets start to present themselves. And last year wasn't a very good time for you to kind of feel like that was a normal state of affairs. But we'll show you some historic numbers so that you can kind of remind yourself of some of the markets that you've lived through, as long as you've been an investor for more than a couple years. So why might there be more volatility now and over time in 2022? Well, we have everybody's thinking about the Federal Reserve and the potential for tightening. So while the Federal Reserve has been buying assets, adding to its balance sheet, with high inflation and also a robust economy, the questions are, how much will the Fed tighten? And when we think of tightening, that could be raising interest rates or selling things that they own back into the market. You have a midterm election, which tends to mute returns in the beginning of the year. So often in a midterm year, the investment returns are later in the year. We still are, of course, living with the reality of COVID-19, 2 years into it, coming up on the 2-year anniversary. Rising rates goes back with that Fed tightening and is completely interwoven with inflation. And then, things have kind of gotten a little heady when it comes to people feeling like it's pretty easy to make money. I have some great stock ideas. There's a FOMO. And so gravity's kind of pulling some of those kind of complacent investing strategies back to the ground. So let's look and just remind ourselves, this is one of my absolute favorite kind of visuals to help you understand what you need to be prepared for as an investor. If you look at the gray bars, we have years going back to 1980. Each gray bar represents the returns of the S&P 500 in a calendar year. So you can see typically those gray bars tend to be above the line. That means that there was positive return. Then you have the red dots. Red equals negative. So that would be how much there was a decline in the overall value of the stock market within that year's time period. So I think a good reference point would be in 2020, when we had COVID, we had a very significant correction, down 34% in that March time period in the first quarter into the second quarter. And yet, shockingly, the stock market ended up 16%. And but that's not a solitary example. You can see that in most years there are pullbacks. I mentioned that last year was extremely, a year where it was highly unusual. There was less than a 10% pullback. So we were down 5% was the biggest pullback that we had in 2021. But already year to date, and these numbers are through Wednesday, we've had an 8% pullback. And even if you looked intraday on Monday, we would have had a 10% correction. Even through yesterday, we might be in that correction territory. So when you compare that over a year, does that look like something that is highly unusual? Well, in fact, it's not. So the average pullback in a year, if you kind of aggregate all of these numbers, is a 14% decline. And it does not feel comfortable when you are going through those declines. If it does, then you kind of got nerves of steel. So what we do is we revert back to investment processes. But I love to kind of frame all of the rest of our conversations in context of this. And there's 100 or 1,000 different reasons that in any given year markets decline. But we're going to go through, kind of the constructive view of where we think we are right now. With that, I'm just going to mention that again, that less than 5% pullback last year was unusual with the muted intra-year declines. But that's not, we've already kind of broken that trend in 2022, but that doesn't mean that we need to kind of eliminate the need to kind of stay with the process that we have today. Okay, I'm going to hand things off. And next up is Melissa Fradenburg. Melissa, tell us about economic growth.
Yeah, so I get the better slides of this presentation to talk about the good news. Looking at the economy in general, things are looking up. So GDP growth is forecasted at 3.5% for this year, which is decelerating slightly from last year. However, if we have 2 years in a row with 3.5% or more in GDP growth, that would be the first time since 1999 and 2000. And if you look at the chart on the left here, that is quite high for GDP historically. And that is going to be driven mainly by robust consumer spending. We have CapEx spending and inventory rebuilding. If you look on the right-hand side, the components of a strong GDP, all areas are looking good with the exception of government spending. There is a drop-off this year in that. However, keep in mind that is including the stimulus checks that we saw, which it's hard not to drop off from that level of spending last year. So GDP is looking good. If we hit that forecast of 3.5%, again, it's going to be driven by consumer spending mainly. and pointing out here some of the things that go into consumer spending are job openings, household spending, cash balance, consumer confidence in the labor market, and wage growth. And this is a really interesting graph here to just show, how above average we are in those areas. The purple diamond represents where we're at currently. The gray box is the historic range, the pre-pandemic historic range. And the blue dash is the historic average. So you see it, right now we're at 11 million in job openings. That blue dash, which is the historic average, is about 5 million. So we are way above that. The household spending is above that average range. Cash balances. The average consumer has $10,000 above average available for spending. Consumer confidence in the labor market is at that high end of the range. And the last one, wage growth, doesn't look as dramatic as the other graphs. However, that represents a 6% wage growth last year, which is a 40-year high. So again, all these numbers are contributing to that strong consumer spending that we think will drive that GDP for 2022. Now, as a group, we talked about not having any slides on COVID. That's our goal. So maybe for next quarter's economic update, that will happen, but I do have to address it in one slide and one slide only. We have a historic daily new case number right now at about 600,000 a day. So it is still here. The good news on this slide is if we look at the light blue line for the graph all the way on the left, that is the death rate. So if we see the peak from last year in the middle of the graph there, January 2021, we have higher new cases, but that number of deaths has gone down. So as it relates to Omicron being slightly less fatal, as well as some of the therapeutics that we have, as well as the vaccine, of course, which is showing that it does lessen the effects and of COVID. How this other good news here is that if we look at South Africa as a model, since Omicron hit there first, we see that after the new cases of Omicron peaked, it was quite a steep decline, and we're hoping to get there in the next few weeks here in the United States. But it looks like COVID is here to stay. Instead of a pandemic, we're looking at an endemic. The good news is we now have a good grasp on mitigation, social distancing. The vaccines, again, are working to lessen the symptoms that you have if you do get COVID. And then, of course, the treatments and therapeutics are there as well. So our goal for the next economic update is not to have a slide on this. And I think we would all agree. And this is another topic that is not fun, which is politics. Washington, there is quite a lot of news coming out of Washington that could cause you to panic. However, when we look towards this midterm election coming up in November, again, this is not political, but for the market loves gridlock. So we are looking at the current approval ratings for the administration would suggest that we would have a turnover in both the House and the Senate, as well as the betting markets. If you look at that, there is likelihood of a red wave. And again, this is not any kind of a political thing. It's just simply that the market likes when there's gridlock in Washington, and it is looking very likely that that will be how the second half of the year is looking. Now, the other piece of good news when we're looking at the current situation is that the Fed is continuing to suggest that inflation is transitory. And for this area, we have several slides. I'm going to pass this on to Hannah Neer to cover. So thank you.
Thank you. So as Melissa said, I'm going to talk a little bit about inflation and interest rates over the past year, as well as our expectations for 2022 and moving forward. So obviously, we all know inflation has been kind of one of those biggest market headlines that we've seen over the past year or so. And as Melissa mentioned, last year was one of the highest inflationary periods that we've seen for about 30 years. So we do expect moving forward that inflation will begin to normalize and kind of the pace will be a little bit more moderate between now and 2023. So looking here at the Fed's forecast, it does also indicate that they believe the rise in inflation is temporary in nature. So we're expecting inflation to drop from about 4.4% last year down to about 2.7% this year, and then dropping even further in 2023 down to 2.3%. So with that, we'll move on to the next slide here. So that's exactly kind of what we see in this first chart here on the left. Those high peaks that we're seeing there is kind of when we were coming out of isolation in the past 12 months. And then from there, we really see core inflation starting to decelerate moving into 2022 and 2023, even further down the road. And then looking at the ISM Manufacturing Price Paid Index, which is the second chart here, manufacturing is typically where inflationary pressure is solved first. And this is just kind of due to all of the bottlenecks that we've all felt this past year. And last week, the most recent update has been released, and this number is already starting to come down. Delivery times have started to decrease, bottlenecks are starting to subside. So that's really good news moving forward. Here we're going to talk about a few silver linings to the inflationary patterns we've seen over the past few years, as well as moving forward into 2022. So during the high inflationary environment in 2021, we saw continued strong consumer demand. And this is good in the sense that it allowed businesses to adjust prices accordingly with that higher cost of manufacturing that they were seeing. So this led to record earnings, continued increase in the equity markets without much in the way of sell-off. We also saw a huge rise in wages during the past year. This is the highest wage growth we've seen since about the mid-'80s, and it has been considered to be kind of an overdue increase in wage growth. And then finally here, the uptick in inflation has taken most of the tax increases off the table, at least in the short term, which many investors have been glad to see. So moving forward, as we kind of look into 2022, assuming inflation does moderate, we can expect that the Fed would have kind of increased flexibility in adjusting monetary policy. Also, we expect that consumer confidence in corporate profits will continue to rise as deflation decelerates. So that's more good news for the markets and spending moving forward, as Melissa touched on as well. So there's definitely been some benefits from the trends we've seen from an inflation perspective, kind of in conjunction with the current state of the market. So we do expect about 2 or 3 interest rate hikes this year, which I don't think surprises anyone. We do feel that the current economy can pretty easily absorb a few interest rate hikes. The Fed is typically extremely patient and will not want to raise interest rates at a pace where short-term rates kind of jump higher than longer-term rates. This type of period is known as an inverted yield curve. And the Fed historically has wanted to avoid this pattern because a lot of times in the past, this has kind of scared off the market. So we think the Fed will be less aggressive than what a lot of folks might be expecting. And then we also believe that the expectations for 2023 interest rate hikes will have more impact on the market than those in 2022. So however, here again, we believe the Fed will continue into 2023 kind of with that cautious approach to avoid raising interest rates too quickly. So to touch on interest rates here, we can see in this chart, and most of us have been able to just feel this, that interest rates have really been trending downward over the past decade or so. As we approach kind of a period of Fed tightening, historically, we have seen that interest rates have started to gradually move higher, which if you think about it, makes sense because the Fed raises interest rates when the economy is doing well. So to entice investors, we do expect interest rates will move higher, but very modestly. We ultimately think the Treasury yield will end up about 1.9% towards the end of this year. We don't expect that it's going to get much higher than 2%. So overall, in the way of interest rates and inflation, things are not necessarily as dismal as we may feel they are. We think there's definitely some optimistic outcomes from kind of the recent trends we've seen in both inflation and interest rates. So with that, I will pass it over to Alexa, who's going to talk to us about the equity markets.
Thanks, Hannah. I'd rather talk about equities than inverted yield curves, so I like my section. The first page that we're talking about is the bull market that we're currently in. The chart on the left shows in dark blue the current bull market, and if we look at that compared to history, it's been super I would say fast and furious up to now. And Melissa and I were talking before the webinar about that. It's crazy. We're very close to entering year 3 of this bull market. They typically last 6 years on average. And this second chart shows year 1, you're seeing the really high returns, just fast growth. Year 2, it does tend to slow down. And then as we enter year 3, we do start to see more muted growth and also more volatility in there. So, this last week, it's not unexpected, but it's definitely something that we haven't been used to with the last almost 2 years now going into this. So, we have been kind of living on a market high during these COVID times, but just kind of being aware that every year can't be like last year, like, what we've seen in the past, and just preparing for ups and downs as they come. So as far as what we like, we are still in favor of cyclical. If we look at the chart on the right, the earnings per share growth for the cyclical sector, just everything still looks good. Consumer discretionary, e-commerce is just continuing day after day to be more and more a part of our lives. Financials, one of the areas that will benefit from the rate hikes, and also just still an undervalued sector there. Communication services, streaming. I mean, I have probably 10 streaming services. And also they think a big year for advertising. We have the Olympics, Super Bowl, all these big events that the advertisers are ready for. Energy, high oil prices, lots of money moving there. So this is kind of digging in the space that we like. And then if we take a step back and look US versus overseas, in the short term, it's hard to kind of predict where the winners will be, but we definitely have a tilt still to US. So this chart on the left in purple is the S&P 500, and in that light blue is the world minus the US. And US has outperformed by 220% since 2007. And, the world has remained pretty flat there. And it's just the growth in the US has been crazy compared to the developed and also the emerging markets on there. So we're not abandoning overseas, but we also are more heavily weighted towards the US. And then Melissa got to share her favorite slide, so I get to share mine today too. It might be a little hard to read, but this has every different color is a different asset class. And then the years starting 2007 going to 2021, it has the performance of each of those asset classes. So it looks like just a mess in there, but this white line shows a pretty balanced portfolio. I believe it's about 60% stocks, 40% bonds. It's not our balanced portfolio. It's just one that is used for the reference, but really just a good reminder about diversification and why we aren't chasing the winners of yesterday. You can see small caps in orange is a good one to watch. It has really great ups, but also some some pretty deep downs there. So we just like to show this why we remain diversified, why we're not, years when the S&P's up 29% and people say, well, why don't I just have only the S&P? And then the years when it's way down, it really just tells a good story over time. The last two columns, I think, are a nice addition that they recently made to this. The second one shows the average annualized return. So we see the white box is pretty nice in the middle there. But the one on the end, that shows the volatility of the various asset classes. So you're getting the returns pretty much over half of the asset classes. And the only thing with less volatility is cash and fixed income on there. So I love this slide, and I love to see what has happened over these years and where the various asset classes fall. I know when I started, it went back to 2000, and just to see when things are in favor and just kind of watch as things change. So that's my little speech on equities. Melissa has some stuff about planning for us before we wrap up.
Thanks, Alexa. I appreciate everybody with the input and insight, and I hope you can see how we operate as a team. We have similar discussions as an investment committee as we kind of develop the investment strategy for our clients' portfolios. The thing I would mention about investment strategy, just before I get into financial planning reminders, is that we're kind of neutralizing some of the overweights that we've had. It's almost impossible to get rid of completely a growth tilt because the S&P 500 itself has migrated so much toward growth versus value, but we're acknowledging the opportunities and price mismatches there are between value and growth, between big and small companies, and even international versus US. I had to laugh, Alexa, because I was a financial professional and investment research associate way back when international outperformed the US. And I think that the number of people that can remember that actually can and will happen at different time periods is becoming fewer and fewer, just because you have to have such career longevity to have been there on those days. But reorienting toward where we want to remind you to be, your financial plan needs to be built for times when the market is up and times when the market is down. I have had a few conversations with clients that are experiencing a lot of regret because of the recent pullback, which, as we mentioned, is less severe than a typical pullback in a given year of up to 14% on average. And so what we want you to do is to remember that this is a part of your financial plan. This is a test where money is changing hands between shorter term investors and longer term investors. And if you look at a very long chart of investing, then almost every time period looks like an opportunity to purchase. It is not, don't overthink the minutes and hours in the meantime. So we want to leave you with some reminders about investment best practices that I think it's really critical for you to either be fully committed to, or you work in conjunction with your financial planner to maintain commitment for. So first, on investing, you need to have a process and you need to stick with it. Our personal process, which I hope that having for most of you known us over the years, is disciplined with an asset allocation that we do not deviate to. We don't pick the weeks and months that we want to be invested in, the weeks and months that we want to be in cash. Why do we do that? Because we've seen that it's a fool's errand to try to pick the perfect moments. And I can say that through 3 bear markets that I've invested in as a professional, going back to the start of my career in the late 90s. Rebalance and follow discipline when you have times both of growth and times where the market is contracting. But if you're in this moment now where you're asking yourself, what should you do? Don't think about kind of erasing your investment process. Instead, consider either accelerating investments, accelerating Roth conversions, tax loss harvesting, and just going through your list of the action items that you typically would need to do and continuing to do them. Also, your emotions play such a big part of your investing success or failure. If you can immunize your reactions to portfolios from your emotional kind of take on looking at your account statements, then that is one of the best ways for success. I don't recommend it, but some people say they just don't open their statements. I'm not telling you to ignore things, but I am telling you to have constructive conversations with your professional financial planner. Remind yourself of the strategy that you've committed to over time and get back to that process. And also just take your temperature and remind yourself of other times where you felt stressed about the market. I don't think it felt comfortable at all in March of 2020, both from a personal perspective with a scary virus that was, taking over the world, but also as an investor. It was an exhausting time period. But now I have that extra memory of knowing what, the advantages of maintaining a process through those moments in time. So make sure that you're reminding yourself that you've been through situations like this before. And also don't overcorrect based on predictions of what you think is going on in the market and where you see it going in the future. So this, and if you looked at people who have been watching the Fed and say that Fed balance sheets are unsustainable, they may have been saying the same thing for the last 15 years. If you look at people that feel like inflation is going to deconstruct the economy, it would be easy with the fact set that you have today to think, oh, here it is, it's all coming true. Don't get overcorrected where you abandon your process and strategy because you feel confident in a prediction of markets. Markets are just too complex to have a singular event overtaking the dynamics of the market. And again, we go back to process, we go back to Alexa's favorite chart on asset allocation as the way that we've learned to manage through and tie things back to your personal financial goals. And then also, so that goes back to financial planning, because as you know, with us at Pearl Planning, we're not just investors, we are financial planners who are thinking about your overall life and how your investments should fit in with that. So if you're sitting, listening and you don't have a financial plan, you're not sure how you're doing when it comes to retirement, you have other big goals that you think you may be able to achieve, but you're not sure, get a financial plan and then update it annually so that you can make adjustments and cross things off your to-do list as they come up. Boost your savings each year. So if you're saving for retirement or your kids' college savings, get that started and give yourself a bump if you're experiencing the opportunities with wage growth that hopefully that you've had along with the average American in the past year. Focus on tax-aware investing strategies and cross things off your to-do list. So I like to tell people to focus on what you can control. And certainly for all of us, we have things that we should have done or had on our list, will be doing. Instead of fretting about what's happening day to day in the market, focusing on your cash flow, your balance sheet, your budget, getting estate planning done, getting the insurance that you need. All of these things are more constructive and helpful in times like this. I know we already have at least one question, but I want to encourage everyone that there is a Q&A where you can just pop in a question and we'll make sure to answer it. And I'm going to just show you our disclosures because I always forget to show them. I moved them up in the slides so that I would make sure that they were included in our recording and playback. This is just a prompt for your questions, which I'm about to get started. And here's how you can reach us on social. And in just a moment, I'm going to share our contact information as well. The first question that we have is with the bull market chart showing slowing during years in year 3, I believe, because that's where Alexa was showing the slowing in the bull market. If that arc continues as it shows, won't we be going into a negative territory in coming years? So perhaps that's a fallacy with the chart. We can definitely show you in the future or follow up with you, Jim, with what the average bull market is, but the average bull market is 6 to 8 years. So we showed you a chart of years 1 through 3. I think it's very telling, showing that sharp kind of V-shaped recovery we had coming out of the shortest recession in history that coincided with the onslaught of COVID-19. But typically bull markets tend to last longer. And if you think about it, prognosticators also say that the current bull market is part of a longer term secular bull market that really goes back to 2009. So they tend to be longer. And if you were to extenuate that chart, you would not see it falling into a bear market on average in a 3-year period. But again, we're not predicting, we don't predict. And we think that, predictions, they're a narrative that feels comfortable. Stories feel comfortable when it comes to investing for investors and for investment professionals like ourselves as well. But we can't predict. We use process to manage through different markets. I think a couple time periods that we've paid attention to, I think there are 3. One is the 1950s, where you had a very low interest rate environment, and you happen to have one year that had a huge spike in the early 50s in inflation. Inflation is very volatile. If you've seen those inflation charts more recently, you may notice that. It didn't feel like that when we had low inflation, but it tends to bounce around. And in the 50s, there was a high inflation year, close to the highs that we have today, around 7%. And then the rest of the 50s were lower inflation, still lower interest rates. And it certainly was not the best decade ever to be a bond investor. But there were periods of time where bonds had decent returns. Also, in this past decade, we had another rising rate environment where there was a lot of anticipation of the Federal Reserve starting to increase rates. I believe this was the year 2016. And leading up to that, there was a lot of jitters in the market. Markets react more to the leading up to than the day of the raise, is what I've seen in the past, at least. Past doesn't always predict future, but it often rhymes. And those time periods, the market became more constructive after that. And then Hannah, I believe, was talking about presidential election cycles, or was it Hannah, or raise your hand, whoever talked about, Melissa. Excuse me. But I spent a lot of my early career, when I only focused on investing for a financial planning company, talking about presidential election cycles. So the midterm cycle is a time where tends to be more muted returns leading up to the elections. And then because then you get from that uncertainty to what you're dealing with, whatever it is, the fourth quarter tends to be more constructive. We're not going to erase the process that's gotten us here just because on average, you have more muted returns in the beginning of the year. So hopefully that's helpful in answering that question, and also giving some context to some time periods that we think have been helpful in the past for markets. So also we've had a lot of focus on inflation. And when it comes to that volatility of inflation, in any time period except for the very highest numbers of inflation, and which, the last 12 months definitely logged in at a higher number. Any other time periods, just like markets tend to have higher returns, that is also constructive for typically in markets. Inflation in a up to 6% range tends to be good for stock investing. What you don't want is deflationary periods and super high inflationary periods. And like we said, we believe there are some reasons, including, adding back to inventories and working out the supply chain, why there may be some, kind of help on the way for those high inflation numbers now moderating. And keep in mind, the future inflation numbers, as we were saying, are going to be compared with these high numbers. They're not going to go back and say, here's what inflation was 18, 24 months ago. It's going to look at a 12-month rolling period. So that's quite relevant, kind of the base you're comparing to. And that's also one of the reasons that the numbers are so high right now. Does anybody else have any common questions, Melissa, Hannah, or Alexa, that you're hearing that we should address before we wrap things up?
No, I think you covered them. I think just, with the volatility, as people are realizing that we've had some down days and some volatile days, just questioning, what should I do? That's the biggest thing, should we change? And I think you addressed that of just staying the course, that you don't need to make big investment changes just because there's more volatility.
The reason that you want to make big investment changes is because you found that you don't have a process that you will stick to. If you found that you have not rebalanced for a while, I think that I would mention too here that kind of FOMO economy of why didn't I buy the best, this name stock and that name stock, the meme stocks. I know somebody's kid in their basement getting rich off of digital currency or new investment. Those are what, don't let that kind of YOLO, you only live once type of investment become your whole portfolio. So if you've added too much risk because you abandoned your strategy, if you haven't rebalanced, if you are someone who feels very comfortable taking on risk on up days, but not on down days, and I'm not saying that it should feel devoid of discomfort in down days. But if that's the case, then you should think about your long-term allocation. It's not about what you should own this week. It's about what you should own for the next decade, and what, kind of risk you should take on in the next decade. So if you're not cut out for that type of risk, then, it's time to revisit your allocation. But otherwise, you need to have a process and stick with it. We appreciate everyone that's joined us, and we will be sure to have this replay available to you and anyone that needs to hear this in the coming days. You can find it on our website at pearlplan.com, and all of us are available for questions or follow-up if you call our office or send us an email. So we appreciate the community around Pearl Planning, and hope that it's the launch of a terrific year for everyone. And thanks for being a part of this conversation. Thanks, ladies.
Thank you.